when you see things this late into the February contract where there's that much gold that could stand for delivery that hasn't yet, it's very, 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 very unusual. And this is the kind of environment where, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States. But that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities moves become really violent.
In a note published Wednesday morning, J.P. Morgan analysts said strong and sustained demand from both central banks and investors through 2026 will ultimately push gold prices to $6,300 per ounce by year-end. Gold just broke above $5,200 per ounce. Silver pushed past $90. In less than a day, more than $1.14 trillion in value flowed into precious metals. Gold alone added over $800 billion. Silver added more than $300 billion. Renowned market advisor Andy Schectman points to an unusually high level of open interest in the February gold contract just days before expiration. Schectman suggests this pattern could indicate that a major short seller may be exposed, potentially having sold gold without a readily accessible physical supply. Andy Schectman argues that silver prices have long been artificially suppressed, preventing true price discovery and discouraging domestic mining. At the same time, the market has faced structural deficits for 6 consecutive years, totaling more than 1 billion ounces. In his view, higher prices are now being tolerated to make deeper, more expensive North American mining projects economically viable and to signal support for domestic supply. However, January's surge in demand is a real-world stress test for the physical metals ecosystem, noting that retail buying and institutional interest rapidly increased pressure on dealers, refiners, ETFs, and exchange inventories. This dynamic has played out amid record silver price volatility in early 2026, including breakouts above key resistance levels near $100 per ounce. Meanwhile, tightening physical supply continues to strain futures markets, with registered silver stocks on COMEX recently falling below critical levels. In Schectman's view, these conditions highlight that investors can't assume seamless liquidity between futures and actual silver. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Andy Schectman's recent interview.
I think we could start with, we'll talk about gold and silver. Everyone's focusing on the March contract. But with the February contract, which completely is gone in a couple of days, right? Like 3 days. As of yesterday, for February gold contract, right? There were still 4,366 contracts open. That's 436,600 ounces, or 13.5 tons of gold. Now, what's unusual about that, in fact, insanely unusual, is that it's insanely high. That number for this late in the cycle. In fact, it's 24 times normal. It's even bigger than the upcoming March contract, which I don't know if that's ever happened. That's a massive red flag, and really what it means, what most people would tell you it means, is a classic fingerprint of a big short that sold gold that they may not actually have to pay back. And if they were planning to buy it back, one would assume that they're somewhat trapped because liquidity is this late in the February contract is very thin. So normally when a contract goes off the board, like, for example, the March contract goes off the board on Friday here, meaning it's time to either roll forward to probably the May contract, cash settle, or stand for delivery. And so when you see things this late into the February contract where there's that much gold that could stand for delivery that hasn't yet, it's very, 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 very unusual. And this is the kind of environment where, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States. But that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities, moves become really violent. We're in a world where price has been suppressed forever to support the military-industrial complex and their ability to accumulate cheap silver to make high-tech weapons for years. Price has never, it's never found price discovery. But what that has done in particular by keeping it so ridiculously undervalued based upon its value and utility, in contrast to its value and utility, its real value and its utility, it is as disincentivized domestic mining. And so when you try and find a mine, not only, silver, of all the metal mined last year, only about 20% came from companies that exclusively mine silver, about 160 million ounces. But that's it. Out of the 850 million or so that was mined, it's the 6th year in a row of a systemic shortage. About 200 million plus ounces for 6 years in a row, a 1.2, 1.3 billion ounce shortfall over the last 5-6 years. And so when you talk about why would they do this, it's being done to incentivize mining here in the United States to make it economical, because you have to dig further. Silver is found in a form very near the surface, epithermal it's called, like your skin being epidermis. And so the big deposits were found a long time ago. To find more deposits, you would have to spend more money that currently are uneconomical, or not currently, but most of the time I've known you, they would have been. And so to raise the level to this degree, which is not really something I agree with, instead just let the market trade freely and you won't need the price floor. But nonetheless, what it signals to the investors and to the domestic mining companies is, hey, let's, if we can get above our all-in sustaining cost enough to find this other silver, here in North America, let's do it. And they'll put a floor underneath it to incentivize it so that we don't end up doing something uneconomical. I think that's really what it's about more than anything. But my pushback would be just get the hell out of the way of allowing these banks to take on what has been for 30 years the largest concentrated short position of any commodity traded on the COMEX market, that being silver. Stop manipulating it, get out of the way of it, let the market trade freely. You won't need a price floor. But nonetheless, that's what they're going to do. And I think it's more of sending a signal to domestic mining companies that go ahead and do it. You'll be okay in your endeavors. January was one of the busiest months we've ever had as a company in 35 years, 36 years. Roughly 1/3 the volume we did in January that we did the entire year last year, which is one of our biggest years ever. And I know you understand that. You were part of that. And all the other companies were too. So you had, for the first time in a couple of years, the public starting to, I think, increase their awareness. Price makes people aware. That's why, the big money, the successful money, who was free from the crowd, was in long before price made it something that caught people's collective conscience or awareness. But we saw a massively expanding demand. At the same time, you see massive leverage on COMEX. And the leverage being, a trader says on December 1st, geez, man, price has been going up week over week over week without stopping. Look, we got $5 million in our margin account. Let's buy a bunch of contracts. For $15,000 or $16,000 back then, we can control 5,000 ounces. At $60 an ounce back then, that's 300,000. So that leverage is fantastic. And it's nonstop going up. So they lever up and buy a bunch of contracts. And again, at $15,000 in your margin account, that's like 70 contracts you could have, right? And you could control 70 times 5,000, 350,000 ounces of metal. You just have to have that money in your margin account. Okay, great. Margin limits have gone up 300%. And so if you don't post more money in your margin, well, then everything is sold. And selling begets selling begets selling begets selling. The prices collapse. This is done specifically to target the speculation, the leverage on COMEX, the people that shouldn't be playing in this big sandbox.
Andy Schectman argues that most analysts and media outlets are completely missing the real story in the precious metals market. Instead of focusing on whether silver is overbought, like in 1980 or 2011, he says the only question that truly matters is who is standing for physical delivery. He underscores that an unusually high number of futures contracts are standing for delivery instead of cash settling, something he views as a strong signal that major, well-informed players are accumulating metal strategically rather than speculating. Recent developments support the broader context he describes. Central banks, including those in China and Poland, have continued reporting significant gold purchases, extending a multi-year buying trend. At the same time, regulators and exchanges have highlighted tighter physical inventories and strong investor demand, while major institutions like J.P. Morgan Chase remain deeply involved in bullion custody and trading. Schectman suggests these trends point to a gradual shift away from fiat reliance and toward hard assets. Let's jump into the interview.
They haven't noticed anything along the way, with the exception of at the top, or as it was getting near the top, that it was overbought, and could this be 1980 again or 2011? Even those that spun it, look, Reuters calls it the devil's metal and all this stuff. So, even if it was spun in a positive light, 1 out of a million articles, they missed the entire bullseye completely and totally. The question is who's standing for delivery to these numbers. That's all that matters. And that's the part that is strangely and I think kind of conspicuously, if you will, omitted, because to me that's all that matters. When you have an environment where information is worth probably more than anything, these people are informed. You don't spend 9 figures a month for a year and a half almost, or a year and a third every month by taking delivery, which is ridiculously unusual outlier. The majority of the contracts that posted in February have stood for delivery. That's unusual as all can be. Normally it's 1% or less. So who is standing for delivery at these levels? That's the only question that should be asked. And the answer and the silence of its reporting, to me, speaks volumes. This is connecting the dots and realizing that the people who have pulled these strings are powerful enough to pull the strings in violation of antitrust law, powerful enough to have Bart Chilton, the former head of the CFTC, to be told to back down, Bart, it's a political decision, powerful enough to let J.P. Morgan continue to run the world's largest silver trust after paying a $920 million fine for manipulating the market, and the second or third largest stockpile of gold in the world. Well, maybe not that large, 4th or 5th if you had central banks, but a massive stockpile. They are the primary custodians with BlackRock of SLV and GLD, and yet they paid this insane fine. So they're powerful enough to do all this. I'm sure they're powerful enough to ask the media to please let this one go and don't bring it up, because it is on behalf of the United States government. It's about national security. So, again, there is a fine line between conspiracy, reality, and how things are going down. But I ask myself, is this really, is journalism and what it stood for gone and dead? Or are they just blind to what is the most obvious thing that I've seen maybe in my career, and that is the most well-informed money, starting with the central banks in 2017 and now not stopping, and now moving also into the big traders here doing it. That's all that matters. To me, that's all that matters, because it tells you that price is just being used to misdirect you or to shake you off the back of the bull. And the rest of it, to me, is moot. It's easy to rest calmly in the face of massive drawdowns when you see the deliveries by these people. But remember, and then you're very right, Dunnigan, and it was harder for people to kind of rationalize that when it was just the central banks of Eastern Europe and the global South. Okay, so Poland and Hungary and Turkey and the Czech National Bank and the Dutch and Saudis and the Chinese and the Indians and the Russians, they're all buying gold and silver. So what? Oh, but now it's here. That's never, when those entities were doing it, not a word about what was happening here. But now you see it here. And that's what's so vastly different. And so too is, of course, the way that this administration has classified platinum and silver critical minerals. And of course, the Judy Shelton talking about what she believes gold's role will be in the future for the U.S. Treasury. Of course, gold and its expanding role in the global South as a settlement vehicle. These things are happening. Media doesn't talk about it at all. So that should tell you, this is why and how big money repositions. They reposition under the cover of media silence and of rhetoric that is contrary to what they're doing and of price. And when you have the ability with tremendous leverage to move the price, it's easy to do to create that narrative. And again, when you see the price get hammered and then you see JP Morgan cover and metal put into SLV and the deliveries continue at a massive clip, that should tell you all you need to know about really what the motivation is. When we're getting to the point where countries, just like they don't want to hold dollar treasuries because they don't trust them anymore, many of them, they won't want to have metal held within the COMEX or the LBMA. They don't trust it. And maybe that's why you're seeing metal move at such a clip. And one of the things that people have such a hard time with is, your mind says, well, why not just buy it all? Right? Why doesn't a wealthy guy like Bill Gates just buy it all? It doesn't work that way. If the Chinese or a wealthy guy says, I'm going to buy it all, good luck getting it all, because the minute that happens, not only do you blow things up within the exchange, but the minute that gets out, everyone will beat you at it and stand for delivery themselves. So this is done by, you bleed out the victim by 10 million paper cuts rather than, one samurai sword to the whole thing. And I think that's the part people have a hard time understanding. They're dismissive of the well thought out strategy of those in the global South to do this methodically. And you can see it if you look closely. It's increasing exponentially from when we started talking about it 5 years ago. And they're doing it the right way, just slowly enough to keep it from being on the mainstream, but not slow enough to where we don't notice it. I see it very, very clearly. And again, I will say it for the 1 millionth time, the only thing that matters is that the most well-funded and well-informed traders on the planet, from the central banks to the commercial traders here in the United States, are telling you through their actions that gold and silver are worth far more than the paper dollars they're using to buy it. That's all I need to say. And I could drop the mic right there and shut this off and walk away. And I would feel if people really listened, they would understand where this is going. You would see massive institutional selling, not buying, if indeed this was something that wasn't as important as I'm trying to make it out to be.
JP Morgan's bullish views with record inflows into gold and silver, falling COMEX inventories, and sustained central bank buying, particularly from countries like China and Poland, are key fundamentals. JP Morgan Global Research's price forecasts are based on strong ongoing investor demand, along with continued central bank demand, which they project to average 585 tons per quarter in 2026. If central banks, major institutions, and well-funded traders are aggressively securing physical gold and silver while exchange inventories tighten, what does that signal about the monetary system? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.